the last 3-4 years haven't been the easiest. There have been a number of startups that have been financed that shouldn't have.
Where you think we are in terms of peaks and trough?
You think in terms of resource allocation, there have definitely been inefficiencies.
We operate on a 100-year plan, and under the private equity umbrella writ large, venture is a huge percentage. Because with a 100-year plan, you're really targeting returns that far out, so you better be getting some winners. I would say most of our new fund commitments are from new managers, and the preponderance of our new commitments is from smaller, directed funds that tend to stay small.
It's so important to remember our purpose, and the function of the money is to support the institution.
We really have to see in today's geopolitical situation that capital is allocated in the correct markets. We need to also allocate capital in markets where we find political stability, currency stability, and also making sure that the governmental frameworks plays along to our favors.
Today's next panel is going to be moderated by Ya-Jo Sun, a reporter from Bloomberg that has experience covering both EMEA and the Asian markets. So very much so looking forward to this discussion. You'll notice a lot more commentary related to this in the report for this year. All right, so to the team, please welcome us, join us on stage.
There you go.
Thank you. Hi, my name is Ya-Jo. I'm a reporter at Bloomberg covering venture capital and startups. Very thrilled today to be joined by Chris Rogers, partner at Knollwood Investment Advisory, a large US-based single-family office, Celine Wong, a third-generation GP and philanthropist, Florian Heinemann, founding partner of a venture capital firm, Project A, based in Germany, which I cover very frequently, and John Anderson, Chief Investment Officer of Imperial College's Endowment Fund. Maybe let me start with you. Given that Knollwood has been pretty under the radar, can you give us a sense of the size and scale and your portfolio construction to the extent that you can?
Yeah, no, but it's a very large pool of capital. The family had the good luck to sell, this is public information, their businesses to Procter & Gamble in the late 80s for close to $2 billion. And that stock rode up quite a bit, maybe 10x before they sold any shares. And you can pick your CAGR for the last 25 years. So it's a significant pool of capital. I can't, but hopefully you can, particularly you managers out there. And we, I would say that in terms of the allocation, we look more like an endowment. We operate on a 100-year plan. We, and under the private equity umbrella writ large, venture is a huge percentage. Because with a 100-year plan, you're really targeting returns that far out, so you better be getting some winners. And your traditional private equity is probably not where you're going to get that.
Just, in terms of numbers, can you give us a sense of the breakdown between public versus private, passive versus active?
Well, again, no, but by the way, we rehearsed this.
Let me go to John next. John's going to tell me more, but you go ahead.
Yeah. I mean, we have a deep public market. That is our largest allocation, and we tend to look for durable compounders that we can hold. We're U.S. taxpayers, and in our perfect public market, we're sitting on deals that we've either been seed, pre-seed, or venture investors, and followed them up through the stack, doubled down, tripled down, and continue to hold them.
So, John, I'm getting the other LP's perspective in the room. Imperial College is just a little bit over 100 years old, but still quite young compared to your peers here in the UK. Talk to us a little bit about how you're managing the pool of money. How big is it, and how much money you're putting into equities, and where are they?
Yeah, so I think we're young on most standards. Even most of our US peer group are materially older than we are, and that's quite an interesting context. And we're very young from a discretionary wealth perspective. We were not created with or provided with an endowment, so we've kind of had to self-endow. So the last 20, 25 years has been just generating enough of a pot of capital to really even exist and be able to build out the idea of a long-term, permanent, 100-year plus vision. But that's clearly where we need to get to. So we're about 600 million sterling. So I think that's about the distribution of the Harvard endowment, whereas it's my capital. So that gives you some sort of context. Of course, fortunately, the British government is only punching us slightly in the face, whereas Trump, I think, is punching Harvard rather harder in the face. So maybe that wealth will find a purpose. But we've been very consistent in that build-up around operating where we believe we can provide investment advantage. So that's real estate within the UK and around West London, and some brave attempts at early-stage deep tech, university-driven intellectual property exploitation, which has driven the same sort of returns of most people in that space, which is broadly nothing. So we're now looking at, how do we continue the benefit of public market American exceptionalism that's bailed us out over the last 10, 15 years, whilst hopefully finding the skill and the aptitude to be somehow better than everybody else, allocating to the few private equity or venture managers who are willing to take our money. So we've only been doing that for the last 2 years. It's been a really intriguing experience. We're supported in principle and indeed in theory by Cambridge Associates, extraordinary data, and they theoretically allow me to play this lottery with only winning tickets, and therefore it's working out the scale of the win. But that probably does mean that I'm not getting the extraordinary 100-year outlier returns, and therefore I always worry about the risk of mediocrity, that I'm simply going to end up with the benchmark returns, which will be fine, but Imperial doesn't exist to be fine.
Let me go to the GP next. Florian, you cut your teeth at Rocket Internet, and you've been in VC for a very long time, and you have seen several cycles. Give us a sense of where you think we are in terms of peaks and trough.
I mean, as everybody here in the room is probably aware, the last 3-4 years haven't been the easiest. Yeah. So, but I think on the other hand, it's a shakeout that we'll see also in terms of managers, and that's completely okay. I think in terms of startups and VC managers, I think there have been a number of startups that have been financed in 2019, 2020, 2021, or got follow-on rounds that shouldn't have. And I think that is still a problem in the market that's not really shaken out yet. And I think a similar thing you see in venture. And venture managers, and I think that's also completely fine. I think if you think in terms of resource allocation, there have definitely been inefficiencies in terms of which still got funded and got a next fund, and so I think we're in a, there has to be, I think, if the whole Trump dust settles and if Europe gets their act together, I think there will be some positive momentum. And as you said, I think, where else should alpha come from if not from innovation? And it will probably look different from what we've seen in the last decade. I mean, the fields of innovation, but generally I'm very positive on venture. And I'm also positive on European venture, not necessarily because of the great capital markets we see here, but I think more because I think the entrepreneurs that we see today coming from Europe, there's a lot more deep tech expertise that's built foundation for these companies, and they are essentially not necessarily global, but there are at least at least the successful ones will have a reach outside of Europe, and they will also be able to capitalize from the US capital markets, from US buyers, from Asian buyers, and maybe also corporate Europe will get their act together finally, and that might be, and I think who said it earlier, Jens Hilgers said if there's one positive thing about Trump, it might be that the kick in the butt that Europe finally needed. And hopefully that's true. And so I'm positive on venture in general, and I'm also positive based on the talent that we see, because I think we still have great talent on European venture.
Celine, if you look at most of the venture dollars raised in the last 2 years, most of it have gone to AI. I'm curious to know which other sectors you feel like are being mispriced right now.
Yes. Well, thank you for the question, and thank you to the host and organizers of having me. I very much, first of all, echoing what my peer panels had been saying. So I'm more on the receiving end of advice. So I'm a third generation coming from a family business that is in renewable energy. So solar is definitely a big area that our investment allocation has been placing. But again, preventing a family from the Kodak moment, it's a big burden that we're carrying on our shoulders. We have to make sure that the business will continue. So not one on having the fortunate side sitting to allocate our assets to making sure it grows to the right direction, but also how can our generation make sure that there's a planet to live on for future generations. So we have a bit of a laugh yesterday. I actually brought my fourth generation alongside. And we really have to see in today's geopolitical situation that capital is allocated in the correct markets, so very much foreign, as you said. As a family, we are Asian-based, but we are very much looking into the European space at the moment. US has been interesting, but given what's happening over there, we need to also allocate capital in markets where we find political stability, currency stability, and also making sure that the governmental frameworks plays along to our favors. And I particularly had been a very curious person also looking into new energy solutions. We all know that the crisis nowadays that we're facing is not only, how's the stock market going to perform? As you also mentioned, yes, the last couple of years were extremely fruitful. We made a lot of capital, cash on the stock market. But what about the crisis of people facing every day? We're talking food crisis, we're talking energy crisis. The wars that we see currently happening, it's because fighting for the next available access to electricity. So there are new techs out there. They need capital being funded, but it needs the braveness, the curiosity, as well as the courage to take on money to invest in something that really is future proven. So being very ESG and environmentally friendly, I know with solar I am a finite. If the sun is not shining, I can't produce electricity. So we had been scouting the market for alternatives. And interestingly, I had found one company on the planet, and I like to believe it's the first one in human history. Believe me, we have a lot of devices. But in particular, Polar Blue in Australia has been showing us something that...
Sure. We can talk a little bit about the anti-ESG tide later. So, John, the low interest rate has been extremely good for private equity, which is why the U.S. endowment funds have really outperformed the public markets for the last few decades. But now you see the likes of Gale and others, dumping their positions. What is the happy medium for you? I know you want to go more into private markets. Where do you see that going?
Yeah, and I think it's so important to remember our purpose, and the function of the money is to support the institution, and therefore getting that balance between finding long-term patient sources of the capital growth which allow us to confidently support, in particular, the discretionary activities of the university, the area where extraordinary imperial talent can then do unreasonable and extraordinary things. And therefore I think that gives me more of a mandate to be risky, be contrarian. And I think the word innovation and the word disruption comes through every time, which is I've got to therefore uncomfortably over-focus on those rare areas where the combination of disruption, innovation and talent will generate new industries and will therefore create long-term scaled-up companies. I would love those to be UK companies, but I'm not naive. So I've got to start at the available end and therefore identify through our network those few rare advantages where we get access that we might not otherwise get because of our status, how old we are in our capital capacity, but therefore really leaning into venture and the earlier stage of things, but then getting that acceptance and understanding from the benefiting side of the organisation that there's going to be a lot of illiquidity, there's going to be a lot of volatility, and that actually big slugs of capital to do extraordinary things in the short term will have to come from philanthropy, not from exceptional investment returns. So you've got to operate within the organisational finances as well as just the investment world. So, but therefore, yeah, tilting to more risk than we're historically comfortable with, and early stage venture and innovation and disruption.
Okay. Chris, your exposure to VC is largely in the US, correct?
70% roughly.
70%, yes. And I presume that some of the funds that you invest in are the mega funds, which have billions under management. And I'm curious about...
Well, let's stop at that presumption.
Okay.
Because that's not actually true. We are in some of those funds. We've seeded some of those funds in the past 30 years, but I would say most of our new fund commitments are from new managers. And let's say we have 125 fund relationships, that might represent 400 fund commitments. You may have, several vintages of each of these funds. I would say both are the preponderance of the alpha that we're getting, and the preponderance of our new commitments is from smaller, directed funds that tend to stay small. And it doesn't mean we're not in some of those bigger funds, but in some ways we have a very broad data science team, and we do a lot of proactive work through the portfolio of all of our GPs. So those funds provide beta, I would say, and data. They're not really where we're getting our alpha in our venture portfolio.
Well, this certainly goes against the power law that some LPs would champion. But talk a little bit about fund size discipline.
Well, I mean, it's really in the numbers that we see, and you mentioned Cambridge. I mean, it isn't hidden. If you look at the averages, and I wish I had them in front of me. I mean, the number of several $billion-dollar or billion-dollar funds that are returning multiple X's is very small. And so, of course, the problem is, and that's part of the initiative here, how do you find those new managers? And does that is obviously a bigger crapshoot, particularly if you're new at the game and you don't have 30 years of data and you don't know the managers who are going to leave the big funds that you want to back. It's very hard because there are more of them and they don't have a track record. We lean into that because we have that data, we have the reputation, we think we have an advantage there, and so it's been working.
Florian, there's obviously such a huge valuation gap between European and American companies, and I think a common complaint amongst European venture capitalists is how their American peers weaponize capital. And I know for a fact that VCs here would have very tough conversations with founders about whether you take a $3 billion valuation. Talk to us a little bit about how that conversation normally goes.
Yeah, I mean, it's a very difficult conversation because obviously every founder thinks they're going to be the next decacorn, and not just on paper, but justifiably so. And obviously you need that conviction as a founder, otherwise you'd not even have a remote chance to get there. And I think that's a difficult conversation in the sense, like, in the beginning, everybody's happy because you still have that grand decacorn vision. And then, you invested for a couple of years. And I would say probably 10% of your portfolio might have a chance to get to this kind of stage. And those are the ones that you encourage to say, okay, it's Series A. I mean, we typically invest pre-seed seed. So it's like, typically we try to get in the US investors like Founders Fund, Sequoia, Excel, etc., at a Series A, latest Series B stage, if we see that kind of potential. And I think in many cases, and I think also the US funds, especially with the Tiger Globals and Core2s being a little bit out of the game, I think they also have gotten that's at least my perception, a lot more disciplined where they put their money in, where they write these crazy checks, with the exception of AI probably, yeah, right now. But my perception is the whole market has become a lot more reasonable and also more aware of what too much capital can do. And you see a lot of these zombie-type unicorns now that raised $500 million in 2021 at a crazy valuation. And basically everybody realizes now, and that's not just a European awakening, that's I think also a US awakening, what too much capital can do. And I think you just have to be, as a founder, and I think that's a difficult thing because you always have kind of the tendency for an asymmetric information relationship. So the founder has a tendency not to be fully transparent to their investors. And I think the true skill or the true art as a venture capitalist is if you're able to establish a relationship, yeah, where you don't believe your own bullshit as a founder investor combination, but are really honest what your true potential is and adjust funding plans accordingly. And I think, because I think there's great companies that are not decacorns, but that can become a $300 million company, yeah? And if you adjust funding according to that value creation potential, then it can still be a great company, yeah? And I think, and that's probably the biggest problem as a founder kind of, or in a founder-investor combination, to have kind of always this realization within the investor-founder management type circle, what is our true potential at a given point in time, and be very honest about it. But I think that conversation has become a lot easier, yeah, than it has been a few years ago, because there have been so many negative examples of the WeWorks where so I think this conversation
not sure why you're pointing at me about that, but
but I think the conversation has become a little bit easier than it has been before. And I think what was actually quite interesting now is you see kind of a group of companies that doesn't need that much money anymore, yeah, because they produce 1.5 million euros revenue after 2 years with per employee with 20 employees. Yeah.
Yeah, let me ask you that. You know, so many AI native companies don't need to raise as much, and you know, which really begs the question. As a GP, how do you deploy capital? How do you convince a founder to take your money?
Yeah, I think again, I think it's completely fine if, you know, companies don't raise hundreds of millions of dollars, because you just destroy value if you know, put money on in a venture-like way on a company that's not a venture case. Yeah, and most companies, I think you have to be aware, are not venture cases. And the moment you put money in a venture-like fashion on a non-venture case, you're actually you're acting value destructive for the company, for your LPs. And I think AI really brings it, or AI-based companies really bring this kind of realization to a lot more people out there in the ecosystem. But there's still lots of companies that need the money. Yeah, I mean, especially if you go deep tech or if you go hardware, software combination. So I wouldn't worry about, you know, that because there's some people saying, oh, now with AI companies you don't need venture anymore because all these companies are going to grow miraculously to hundreds of millions of ARR without venture investment. That's not true. There's just a group of companies now, and that's great. Yeah, that can grow with less. And I think being very disciplined on what is actually a venture case that needs money and where your money actually compounds, yeah, as you said, and will create compounding value. I think that's really the thing that you always have to be very transparent and aware of. Yeah.
And I think maybe adding to that, often nowadays it's not just the capital that's relevant to the startup or to the company investing in, but also I always take a very close look at who is already co-investing. Apart from the money, you know, that can help them in all sorts of aspects, does their network that they bring along, or does my network help them to accelerate the next milestone? So that equally is just as important. And when sometimes, as it's too much money, that actually, I don't want to call it make companies lazy, but you get a too comfortable situation. So you might lose that hustling mentality because, oh, I've got money in the bank. So, and that can be also extremely dangerous as well.
Chris, talk a little bit about your secondary strategy.
Well, we've had an active secondary strategy for a long time. It probably derived mostly from the when we set up a partnership, we don't view us as limited partners. We're partners with the GP, and sometimes the need for liquidity would arise, and we happen to be relatively capital unconstrained, and so you can start doing that. We've then broadened that out to founders, and we have in the last, I'll say 10 years, we've been in a position where we can provide almost an institutional bucket of capital. Let's say it's $100 million for a company that is pre-IPO, and this can be deployed over a couple of year period as they build to the IPO. So I'd say it's now a sophisticated strategy, but it used to be relatively ad hoc. When somebody needed liquidity, we could be there.
How big is your investment team?
The investment team is, I'll say 12 people.
Okay. So, there's some other family offices here in the audience, I think. And I think the question that a lot of family offices ask is, do you do the investment part yourself, or do you outsource the CIO role to some big firms like, for example, BlackRock, right? Like they offer services like that. So make the case for doing it in-house, and can you just inform the audience what are some of the essential elements to do this successful?
Yeah, well, so I think we have a set of circumstances that isn't everybody's set of circumstances. We had a good exit. It ended up being tax-free because somebody in the 1930s had put the company shares in trust vehicle. It had a great uptick. We don't have that many family members. That has allowed all of the capital to essentially stay together through Gen 6. And so when I said investment team, I was really focused on sort of the private investment team. There are 85 people in the family office, and none of them are family members. So I think that right there is an important differentiator. It's not that the family isn't involved. They know what's going on, of course, but they're not trying to manage that capital. We also don't have any operating businesses at this point. So to your point of keeping a legacy business alive and those kind of pressures, that's not part of this. This is an investment vehicle that's highly liquid. And so I think, I just don't know that every family office can play that game the way we do. And we've been at it a long time. And so we've been in venture a long time. We seeded NEA 30 plus years ago. So we have a database that is also sort of very valuable, as you can imagine, because everybody's got the tools now, but what is the data that you're using? And so I hate to give other people advice for what the critical components are.
Okay, all right. One size does not fit all. Okay.
May I ask one question? Are you still in NEA, like the 8 billion, 10 billion, whatever?
No.
Okay.
We'll follow up on that later. John, so Larry Fink wrote in his annual letter that 60-40 no longer truly diversifies investors, and he is advocating for 50, 30, and 20, 20 being real estate, infrastructure, and private credit. What's your thought on private credit? It's extremely hot these days.
Yeah, and again, I think I always look back to the fundamentals. My job is CPI plus 5%. In reality, I shouldn't have to do anything other than own the public markets and do my best to make no trades and nothing every year. And unfortunately, I'm not as good as that as I should be. But therefore, as I look at the places where I might add diversification, I'm always looking for things that ought technically to deliver CPI plus 5% returns. And my gut instinct is credit shouldn't. If it's driving those sorts of returns, it's looking for equity-like returns. It's more than likely to end up having equity-like performances. It will have blow-ups. It will have frailty. It will have management consequences. It will be sensitive. It will be volatile. And it's really important, I think, when you're a strategic asset allocator with just too much choice, to narrow it down to the things that you can pay the attention and put enough quality analysis on to hopefully be lucky more often than not. So I've had a lot of inbound expressions of interest as to why private credit should be the space I'm moving into, but I've actually been very resistant to that, and therefore really focused on areas where my return and my risk are appropriate in a much longer term context in the nature of the part of the capital stack I'm in. So yeah, I can see where yields are 8, 10, 15%, and therefore you can get not just more than your distribution, but your return just in yield. That's massively appealing, but it's also economically irrational and therefore makes me deeply uncomfortable.
Speaking of another really hot industry right now, it's defense. And Florian, Project A is invested in quantum systems, ARX Robotics, two companies which I follow very closely. There are other investors who probably want to dip their toes into defense investing as well. Give us a sense of, maybe the Instagram picture versus the reality. What is the reality of investing in defense?
I think right now, obviously, there's momentum, and also in Europe, and momentum obviously helps venture, But I think what we can also see in other examples over the time, like the moment this momentum stops, things become a lot more difficult. I think there will be defense momentum for 10, 15 years plus in Europe because we've just so much to catch up. And I think what you see is, still of the 500 billion, for example, that Germany wants to invest in defense, probably the majority as it stands right now will go to the US, because Germany is not able to produce that, especially the expensive equipment. And that's the case not only for Germany, that's also the case for other European and NATO players. And obviously that will not change completely, but obviously with the current political environment, there is the tendency that the primes in Europe benefit, and you've seen it with Rheinmetall and KNDS, etc. But also obviously the startups will benefit. So we see quite a, we're quite positive that this momentum will stay the same. Will this lead to 10 new unicorns in defense in Europe every year? Probably not. So there will be consolidation, and I think quite similar to the point I had earlier. I think you have to recognize where you have kind of an Anduril-like potential. Where you say Anduril is, I don't know who follows Anduril in the US, but they are extremely efficient. It's a little like SpaceX turned into, the weapons sector, where they have 5,000 people and cover a whole range of weapons categories. They have this battle management system connecting it all. So it's kind of prime 3.0 type development, and there will be a few companies, maybe Helsing, maybe Quantum, that can replicate this kind of development, but I think everybody else will be merged either into an existing prime or will be merged into Helsing, Quantum, whatever. So I think you have to be very realistic on what path you're on, and you have to adjust your capital investment acquisition as a company to what your potential is. So I wouldn't. It's like a little like AI. I wouldn't be just investing blindly into whatever defense asset, but really see whether the asset has prime potential or not. And there will probably be 1, 2, 3 companies per year max that have this potential.
I think I'm being asked to wrap, but I do want to ask, just a rapid fire question. I want to ask each of you, what is something, it can be a technology, it can be an industry, it can be a financial vehicle that is overhyped right now? I'll go from you.
I think Chicago School capitalism as the mechanism for delivering us a more productive future. I think that is in its 70th or 80th year of being overhyped, and I'm excited about what becomes next, whilst also a little trepidatious.
Many things, but one thing that really strikes me, because I listened to it yesterday, is the All In podcast. I think that's overhyped.
Anything that has an AI in front of it, I think is often so overhyped because it's tangible. As long as you put it in front, and people make an assumption. But I think what's underhyped, what I mentioned earlier, is anything new energy technology related, and especially in zero emission related aspect, which is currently my pet project. And this, I think, is so underrated, and such a market out there, but people are just not so much paying attention to it.
So I would say both AI and longevity have so many overhyped companies that they hide the obvious opportunities, and I don't think you should go by that kind of trend. Don't take the moniker and say, I'm steering clear, or I'm going all in. You've got to analyze the company and its prospects.
All right. Thank you all so much. Appreciate it. Thank you.
Thank you.